Many investors have far more options for meeting their investment goals than they may realize. Those seeking income or growth or for ways to protect against losses may want to consider private markets and less liquid areas of the fixed income market. In the past, high investment minimums and suitability requirements limited individual investors' access to these types of investments, but interval funds help make investing here possible. An interval fund is a type of closed-end fund that pools shareholder assets to invest in a wide range of securities. Interval funds aren't an asset class. They're a vehicle designed to help individual investors access assets in private markets and less liquid areas of the fixed income market. Interval funds are similar to mutual funds. Both are registered under the Investment Company Act of 1940, have many of the same regulatory protections, and offer low investment minimums. The key distinction between the two relates to liquidity, which refers to how easily an asset can be bought or sold. Mutual funds offer daily liquidity, and as a result, cannot invest more than 15% in illiquid assets. Interval funds, on the other hand, give investors the option to sell their shares at stated intervals, typically quarterly, semi-annually, or annually. As a result, there's no limit on the amount of illiquid assets these funds may invest in. Because interval funds don't need to cover investor redemptions on a daily basis, they tend to have a more stable capital base than a daily liquid mutual fund. This gives portfolio managers the flexibility to execute strategies that are better suited to less liquid assets and longer holding periods. They can invest in private markets, such as private debt and real estate, and harder to access areas of the fixed income market like high-yield bonds and loans. These strategies take advantage of an illiquidity premium, an attractive trade-off for accepting a lower degree of liquidity. A more stable capital base also means managers can use available capital to take advantage of opportunities that arise as market conditions change. Individual investors may find interval funds desirable for their potential to help them meet a variety of objectives, like a source of stability, differentiated returns, or a higher level of income compared to traditional investments. The strong alignment in terms of liquidity between asset and fund type makes interval funds well suited for accessing less liquid opportunities at a time when investors are looking for new ways to reach their financial goals. To learn more about interval funds, reach out to FS Investments or visit fsinvestments.com/interval funds. Interval funds provide limited liquidity, with no guarantee that an investor will be able to redeem their shares during a given redemption period. Because selling opportunities are restricted, an interval fund should be considered a long-term investment. When investing in interval funds, financial professionals and their investors should first consider the individual's financial objectives. Investment constraints such as risk tolerance, liquidity needs, and investment time horizon should be taken into consideration.